Good evening, everyone. Warm welcome to all of you joining us today. At Incred Premier, we believe wealth is created when timely insights meets disciplined investing, and few moments demand that combination more than the one we are in right now. Indian equities have had a remarkable multi-year run, but past 1 year has been quite challenging, to say the least. Valuations are being keenly debated. FY27 earnings expectations are being recalibrated, and global capital flows are shifting away from India. As your wealth partner, we believe you deserve to hear the market not from headlines, but directly from the people who manage thousands of crores through these very cycles. That is exactly why we have curated today's session, Equity Market Outlook and Way Forward, by Mr. Manish Gunwani, one of the most respected equity minds that we have. Over the next hour, you will hear a candid, unfiltered view on where the market stands, where the opportunities lie, and how a seasoned CIO is positioning portfolios today. To introduce our guest of honor, Mr. Manish Gunwani, CIO Equity at Bandhan AMC. Mr. Manish brings over 3 decades of experience across equity research and fund management, and he's been at the helm of during this during some of the most defining periods for Indian equities. Before Bandhan, he served as CIO Equities and Nippon India Mutual Fund. Prior to that, he has been with ICICI Prudential AMC, and currently he's managing Bandhan Small Cap, Bandhan Large and Mid Cap, and Bandhan Large Cap, all three which are a part of our focus and Reco funds. He is an alumnus of IIT Madras and holds a postgraduate diploma from IIM Bangalore. Outside markets, he is an avid reader of history and a devoted football follower too. So, Manish, the floor is yours. Uh, Over to you.
Hi, thanks for the kind words, and thanks everyone for your time. I will just go through a formal presentation, uh, and then we can open the floor for questions. Uh, yeah, Jenna, is visible the presentation? Just confirming.
Yes, we can see your presentation.
Sure. So to start off, first a very long-term view on equities. Uh, we find that the best way to look at equities from a long-term perspective is to look at what has been the real return generated. The real return is essentially the return above inflation. And the good part of this parameter is that it doesn't just work in India, it seems to work across the world, that whether it's US, Europe, UK, Canada, Japan, India, long term, the real return on equities tends to converge somewhere between 6 to 7%. That is, equities invariably return 6 to 7% above inflation. When we look at what has been happening in India, last 10 years, the real return is about 8.2% today, which means that the market on 10-year basis is expensive, because this should ideally be between 6 to 7%. Obviously, the overvaluation is not much; it's 1%. But on 20 years, which is even long-term data, the real return has been only 4%. Now, obviously, even long-term data, there is some base effect. 2006 was a end part of a bull market. 2016 was a depressed market. So it's fair to say that if I average out 8 and 4, it's about 6%, which is the theoretical fair value range of equities. So just to summarize, we are basically at fair value. There is nothing to be fearful about in equities. There's nothing to be greedy about. Clearly, if the market uh, stays flat for a few more months, the more time it stays flat, the more positive we should become, because that means we are entering the undervaluation zone. Our thought is more to focus on portfolio construction. Where should we be, rather than being very defensive about equities, because we generally feel there are fair amount of opportunities. Valuations are not expensive. So when we see what big themes that will play out next 2 3 years, I think the two biggest themes which we feel will influence the market are these two. One is on the horizontal axis, the impact of AI. Uh, Impact of AI, obviously, in a broader sense, is important for all sectors, but particularly for Indian economy, because services exports are 200 billion. Services includes IT services and a lot of the captive centers which India has, which do all kind of work, accounting, auditing, consulting, etc. Um, and the second is the whole dynamic between China and America, and even the Iran war is in a way a proxy war between China and US. How does that play? If China continues to emerge stronger, which has been the case over last 1 year since the trade tariff war started, um, there is obviously a different outcome versus US remaining the undisputed superpower. Um, on the horizontal side, if AI disrupts a lot of services jobs, which means that India will definitely get impacted because that is our biggest export. The outcome is different versus AI not disturbing services jobs. Now, last 30 years, obviously, we didn't have AI and US was dominant, which is why if you see the large cap index typically is positioned for these two changes not happening. So most of the sectors in the large cap index, like IT, consumption, which I include private banks within that because private banks are typically retail lending oriented. Um, and then you have FMCG, auto. So about 60% of large cap index is these segments which rely on uh, consumption, services, exports, focus on US as an export destination. Um, if these two themes were to play out, that is, if AI disrupts services jobs and China emerges, and which will show up in yuan appreciating versus the dollar, then I think the sectors that will lead the market will be very different from the large cap sectors. Because obviously, if let's say the Chinese currency appreciates, that means Indian manufacturing will get a boost because if rupee depreciates against yuan, we will have more competitiveness in manufacturing. Generally, if dollar weakens, then commodities do well. When dollar weakens, global liquidity is good, so global capex will be strong. So the themes that will work will be very different depending on outcome of these two themes. And while no one can predict with 100% certainty, we believe that there is more probability of these two themes playing out, which means that sectors like manufacturing, commodities, global capex, utilities will have a better chance of working rather than the large cap dominated sectors like IT, private banks, FMCG, etc. And this is part of the reason why we've been a bit more bullish on small caps than a lot of our peers, that we generally believe that the nature of global economy and nature of domestic economy is changing, which is captured more in smaller companies than what has worked for the last 20, 30 years. Just to elaborate on these two, first, the China versus US dynamic will obviously not be a single event in a way, whether it's Ukraine or Iran, maybe Cuba, maybe Taiwan, it will play out across different points in the globe. Each has their own strengths. US obviously controls a lot of chips like AI chips like NVIDIA. Uh, airline technology, Boeing, etc., a lot of software products. China, on the other hand, is very strong in manufacturing, battery chemicals for EVs, and maybe the strongest point is the rare and critical material chokehold they have. On the financial side, US has a bit bigger problem that government debt is very high. China, that way, from an external side, is very strong because they have a huge current account surplus, they have huge forex reserves. Um, but again, China on the social side is a bit weaker because their demographics is worsening at a very fast rate. There is obviously overcapacity in property market, and being a centralized economy and centralized politics, the social tension is obviously high. So each has their strengths, but what generally will happen, we feel, is the world will no longer be as peaceful as it was from the fall of the USSR in 1988 to 2020. So we should be ready to live with geopolitical shocks once in a while. On the AI side, again, things are going to be very volatile. There are experts in both sides of the argument. Some believe that IT and all the routine jobs will vanish. But generally, new technologies have ended up creating jobs rather than destroying them. So we don't know how it will go. But again, the initial feel seems to be that at least pure IT services has got impacted by AI. Um, and definitely the new job creation probably will not be pure IT services, it will be somewhere else. So one of the challenges for the Indian market is this AI mega theme is so big, it's got so much capital getting invested into it that India relatively is looking quite pale. So if you see some of the big emerging market AI plays, their price performance has been remarkably strong. I mean, a lot of them have been 3 or 4 or 5 or 6 times just in the last 1 year, and that too at big scale. Like SK Hynix has gone from 100 billion to $600 billion market cap in 1 year, and obviously a lot of foreign funds are now chasing these stocks rather than looking at India because there is genuine earnings growth there. You can argue that it's a cycle and it will end at some point. And from that perspective, they may be overvalued from a long term basis as well. But at this point, the earnings momentum in AI stocks is quite phenomenal. And it's becoming difficult for foreigners to get excited about the fairly steady Indian growth stories. Other issue we also see from a large cap perspective is consumption, which is big part of large cap. It also relies a bit on demographics, and um, I think in richer states the population is going to peak out soon. The number of students in Indian schools has already peaked out. So that is another headwind for mass consumption, which is why in general we don't like this theme. Uh, However, having said that, we think both global liquidity and domestic liquidity will be strong for the markets. Um, why global liquidity is basically very simple that the governments across the world have racked up huge amount of debt, and when governments have a lot of debt, it is in their interest to keep monetary policy loose, because if you think about what can governments do to manage their own debt, uh, see increasing real GDP or reducing expenses or increasing taxes, which are obviously intuitive ways of reducing government debt, but they're not politically easy to do, right? I mean, it's very difficult to get voted by doing these things. So the easiest way, and which we've seen play out in, let's say, Japan for last 20, 30 years is just that you keep interest rates close to inflation or even below that. So what we call the real interest rate, which is interest rate minus inflation. If you make it zero or negative, essentially what you're doing is um, getting nominal GDP will be strong because inflation is high. So your tax revenue collection of governments is high, and the cost is the interest rate. So essentially, for governments, the gap between inflation minus interest rate is very useful because with inflation, your tax revenues goes up. But if you keep interest rates low, that means your borrowing costs go down. Now that obviously means that people don't make money by having cash or putting cash in the bank for low returns, because obviously if your interest rates are less than inflation, then you are losing purchasing power by not having growth assets, which is why we feel that we are living in a world where because of government debt, you're better off being in risk asset. Now, obviously, you can keep rotating them. So whether it's gold, silver, emerging market funds, US tech, Europe fund, or Indian equities, uh, each will have a 2 3 year cycle where they may outperform. But not being in risk asset is also a risk in a weird way, because if you are very conservative and hold cash or bank FDs, then the inflation is going to eat away your purchasing power. Near term, we do think India market will have, not India market, the currency will have a big challenge. Although long term, our inflation, current account should be broadly controlled once this war stops. But definitely near term, we think rupee will be under pressure. Why we think domestic liquidity for stock markets will be good is basically the competition for equities is real estate and gold. Now, real estate again has had a strong cycle post COVID, both in prices and volume. And we are seeing that over the last couple of quarters, real estate sales also are slowing down. They're not degrowing, but the growth rate has definitely slowed down. In terms of gold, obviously, gold is a big asset for Indian households. In fact, right now, probably the value of gold holding in India is to the extent of $4 to $5 trillion, which is more than double of household deposits in banks. So with this price rise over last 2 3 years and the amount of gold which India owns, which I think is 30 to 35,000 tons, um, it has become a very big part of savings. Um, but we think, given its increase in value, incrementally, not sorry, not too much money will flow into gold as much as was flowing over the last year or so. So, in a way, both real estate and gold, the allocations there should reduce, which should help equities. So, just to summarize, our market view is basically that near term, lot depends on Iran war, not just because of the oil price and fertilizer price. Um, Essentially, FI flows are important for India, not only from a stock market viewpoint, but for the currency viewpoint. And unfortunately, as long as the war is on, India will be seen as impacted by the energy prices. So even foreigners will find it reluctant to buy Indian stocks, which means that there will be pressure on the currency as long as the war is on. But if we just step back and take a 3-5 year view, as I said at the beginning of the presentation, that the long-term indicators suggest that we are at fair value. There are bottom-up lot of opportunities, lot of stocks haven't done much in last 3 to 5 years. So absolute valuations have improved versus, let's say, 18 months back. Relative valuations relative to other emerging markets and gold obviously also have improved a lot, because actually, apart from India, most other stock markets have done very well over these last 4-5 quarters. So whether it's US or emerging markets or even Europe, the markets have gone up a lot. So our relative valuation, our relative price to earning multiple has improved versus other markets as well. Thirdly, um, while the war and general inflation is a challenge for the domestic economy, actually for equities it's not a bad thing, because obviously the economy's nominal GDP growth goes up when inflation goes up, and corporate earnings are linked to nominal GDP growth and not real GDP. So in a way, inflation to a certain extent helps corporate earnings. Obviously, if inflation starts crossing, let's say RBI's upper band of 6%, then monetary tightening will start, and that is bad for equities. But as long as it goes from 2% to, let's say, 5-6%, it's actually good for nominal GDP, it's good for corporate earnings, and therefore it's good for equities. And we do think that actually for FY 27-28, we will see double-digit earning growth as long as the war is over in, let's say, next month or so. Because clearly, if Brent oil trades above 90, 100 for a lot more months, then there'll be a big challenge. But I guess globally, markets believe that this war should be getting over soon. Um, so yeah, so overall earnings, we're not so worried about maybe 1 quarter here or there because of supply chain. There'll be an issue. In fact, whatever results for quarter 4 have been published, in general, the earnings have done much better than people thought. And even the real-time data in terms of things like auto sales or GST collections, etc., doesn't seem to be too bad at an overall level. So the economy seems to be holding on right now. Uh, in liquidity, as I said, both we think domestic and globally liquidity will be quite healthy. So we're more focused on uh, identifying the mega themes, how they will play out, and what are the segments and sub-segments which will do well. And as I said, we generally believe that on a 2-3 year time frame, manufacturing, utilities, commodities, global capex, that space will outperform the more large cap space of consumption, IT, private banks, etc. Um, so with that, I'll stop the formal presentation and maybe we can open the floor for questions.
Yeah, thank you, Manish. We had some questions for you, Manish. Recently, on one of the news channels, you had said that India's underperformance relative to global markets is likely behind us, which you sort of said here also. And FY 27 earnings should be stronger than FY 27 earnings should be stronger than FY 26. So for our clients who are sitting on cash today, this is the central dilemma. Is this the time to deploy decisively into equities, or does a staggered approach stretched over a longer period still warrant?
So my view is around the base allocation, you should not wait for better timing. So let's say, for example, if someone 30% of assets are in equities, somewhere around 25 to 35, you should minimum have at this point of time. Uh, I don't think you should wait for staggering because markets are cheap actually. They're not at distress, but they're fairly interesting. Uh, so yeah, I'm not very defensive right now. You can say that we can stagger around the war and all, but honestly, we've never been able to time these things. So yeah, I would say that at least till base allocation, there should not be any need to time. Now, obviously, above the base allocation, maybe you can time it a bit by staggering.
Thank you. The next question is that you manage strategies across entire cap curve. You know, you have a large and mid, small cap. So if a client were to walk in terms of market cap allocation, uh, of course, it has to be in sync with client's risk profile, but tactical bit, which space out of these would you say is something that person should be present in, and which pocket is overvalued?
So my sequence of preference is small caps over large caps and small caps and large caps over mid cap because I feel mid cap because it's a narrow set of 150 stocks where a lot of institutional money has been crowded in. Generally, the risk reward is a bit adverse there. See, small caps, because they haven't done much for last 3 years, they can give you good defense and maybe steady returns. Uh, but if you ask me, if you have a 3 5 year time frame where you're not going to be very worried with volatility, then I would say small cap is the best place because uh, the choice is very big. I mean, we can look at, I think any institution, mutual fund can look at, if they want to look at least 700, 800 stocks. And the second is, as it's said in the presentation, that the global economy and the Indian economy, I think the way they will behave, the sectors which will do well, they seem to be very different from what has worked in the last 20, 30 years. So typically, your large caps reflect what has worked in the last 10, 20, 30 years, which is why they became large cap, right? Um, but whether it is, let's say, currency where dollar was dominant, but I don't think next few years dollar will be as dominant it was before. Last 20 years, 30 years have been very peaceful globally. Obviously, we don't think that is going to happen. The free trade, which was very assumed was normal, is not going to be there for the next 10, 20 years. So the next 10, 20 years look very different from the last 20, 30 years, which is why I think the new themes that will emerge typically start with small caps. And therefore, we generally think that uh, it may need a bit of patience, but we need to be in small caps.
How a retail investor like us can participate in sectors that you have mentioned, like manufacturing?
So there are various ways. I mean, see, all diversified funds can choose to be in these sectors. There are also actually specific themes like manufacturing fund, but that becomes too narrow, I think. Um, so I think a diversified fund, whether it's a small cap, mid cap, large cap, flexi cap, large mid, whatever, that can have fair exposure to these themes. So you don't need to go into very narrow sectoral themes to get exposure here. It's a vast space. It's not like there are only 5, 10 stocks in manufacturing or utilities or commodities. So it's a broader universe where even big funds can get significant exposure.
Sure. In fact, that's what we at Incred also believe, that these sector views can sometimes change quite sharply.
Yeah.
And if you invest via mutual funds which are diversified, then you get to be part of it when that particular sector is on the upside. And when the views change for any reason, which may be, that's the point of time wherein the fund manager would start cutting positions into that particular sector and move to another. Thus, moving in with fund managers like Mr. Manish, who has a strong view and would have an overweight does in his portfolio or a appropriate weight in the portfolio to manufacturing would be the right way to get an exposure to it. The next question that we have is it required to stay in top IT companies or come out? I think this also stems from the whole AI thing.
AI.
You addressed it to some bit in your presentation, but yeah, it's a specific question here.
So I guess it all depends on the objective. We are generally benchmark driven. So I will say we prefer to be underweight the sector, but we will not be zero at this point. Look, the sector is very cheap on free cash flow or price to earning multiple, but disruption through AI is a very significant challenge for the sector. Now, as I showed in the presentation, there are two opposite schools of thought. That one believes that a lot of services jobs will permanently go away because of this. The second school of thought believes that whether it is cloud or PC, all new technologies end up creating new jobs and not reducing the number of jobs. Uh, we think that while it is true that new technologies create jobs, but it may take a time gap between the jobs which are reduced versus the jobs that are created. And the other issue might be that the jobs that are created may be of a very different skill set, or they may be in a very different geography than where the jobs go. Um, so, so we're waiting and watching. We feel although valuations are cheap, there is at this point not enough confidence to go overweight on the sector. If you are an absolute return investor, uh, maybe you can not touch this sector because it is too confusing. Matlab, see, as benchmark investor, if let's say the sector weight is 10, we will be 5, 7, 8, depending on the fund manager. Will not be zero, I think, because the sector is too cheap to take that risk. Uh, yeah, that's broadly how we're playing it.
No, interesting. Also, like I read somewhere that it's not AI which will take I job of people working in IT. It's people working smartly with AI who
Yeah.
will take the job from somebody who's not using AI to maximize their efficiency. Yes, the nature of the jobs will change, like you said. That's there. Uh, Another interesting question is the current Indian equity market shifting from liquidity-driven momentum to earnings-driven stock selection?
Look, the markets are always a mix of this. But yes, I think there is obviously more comfort today that the PE multiple is less than what it was 4, 5 quarters back. Second, in fact, I think with inflation coming back, it's good for earnings. So the confidence in better earnings growth for next 2 years is higher than it was 1 year back, which is why I'm not so very defensive on equities. I think the bigger question, what will do well within equities, is important, but being very defensive on equity as an asset class is not, I think, the right approach because, as I said, inflation is good for equities unless it crosses the point where interest rates start to rise, which I think at this point is far off because I don't think RBI is going to hike interest rates till 6% inflation comes through. Uh, so yeah, I mean, It is obviously a more earnings driven market than liquidity versus 5, 6 quarters back. But again, see, without liquidity, nothing ever gives you return, right? I mean, so we
Correct.
can never say that we are a private equity market which is not listed or where there's zero liquidity. But yes, it's a more fundamentally it's a more comforting market at this point.
Sure. There are two questions sort of overlapping. I will take them together. With FII pulling out dollars, liquidity and costs going up significantly because of global energy shock, are we getting into a squeeze and may land up in recession, increase crude oil price, and rupee depreciation's impact on Indian equity market? Essentially, the same point that rupee has been devaluing and energy costs are up. How do we see it impacting India?
No, so we should not be complacent about near-term challenges. I think just because the war is on for 2 months, people have started to believe it will not impact us. In fact, I think the longer it goes on, the more challenging it is for the Indian economy because obviously at this point, the government and large corporates have shielded the consumer from the effects of high energy prices. So obviously, petrol, diesel prices haven't gone up. A lot of the big companies like Asian Paints, Nestle, Lever, they haven't really hiked prices to the extent the raw material cost has gone up because everyone believes this will be temporary. But if it goes on, then we will see further hikes in product prices for customers, which will be bad for inflation. And also, our current account will shoot up a bit. And with foreigners selling stocks, obviously our reserves are under pressure. And the longer again this goes on, the more pressure on forex reserves will be there. So I'm not being complacent about the fact that next few months, weeks, whatever the war goes on, is going to be not good for the Indian economy. Uh, Having said that, as I've said, the activity levels are actually holding up as of now quite well. But again, as the the real price increases haven't happened from the government or the big companies. But again, the point with equity is just like with COVID, Lehman, when it is darkest, it's the time before dawn. The time gap between night and dawn, no one knows. When we see a lot of the companies which haven't given any return last 3, 5 years, and I'm not even going to mid and small caps. I think a lot of the nifty mega caps themselves have been flat for 3, 4 years now. Clearly, the price to earning multiple or price to book has come down a lot. Uh, and therefore, see, between the war and let's say this AI theme, um, correcting in one sense, because see, a lot of money is going into Samsung, TSMCs of the world. Beyond a point, I think this momentum will stop. It may take 6 months, it may take 1 year, we don't know. But finally, I think India remains a good, steady, maybe 11, 12% nominal GDP story. So finally, foreigners will come back. So we can't wait to time all this. But yes, so it's a mix of near term. Obviously, there are economic challenges. But yes, I think the valuation is what we need to focus from a long term perspective, and that looks interesting to us.
Okay, I know you're hard pressed for time, so just one last question, and maybe I will squeeze one quick one after that.
Yeah.
Is What is the investment philosophy of Bandhan Small Cap?
So we have a fairly simple philosophy that we try to buy stocks which we think will double in 3 to 4 years. Um, and the logic for this is as follows: that like market we think is fair value, so over long term market will return nominal GDP of a kind of return like 10, 12%. Now, assuming that we have this mindset that you try to buy stocks with double in 3 to 4 years, if it actually does that, it is 18 to 25% CAGR returns. But obviously, again, our hit rate will not be 100%. So let's say out of 10 stocks we buy, that is true. It may work for five, six, seven of them. Others may returns may be less than that. So on a blended portfolio level, we think uh, somewhere between 15-20% is possible with that mindset. And that is, I think, a reasonable alpha over what uh, the market will return. Now, obviously, if our hit rate is higher, we may do higher. Hopefully, that will happen. But that's the simple thing, which is why if you see, we don't stress about being in cash to a certain extent. At peak, we were 16% cash about 6 months back. Even today, we are 11-12% cash. So if we don't find ideas that meet that criterion, we just sit and wait. But having said that, we have another philosophy that we don't take big macro risks. So it's not like if we find good stocks, we will be only in exporters or we will only be in cyclicals. We try to balance the portfolio a bit across different sectors or macro calls. So basically, we should not get hit too much if rupee depreciates too much. We should not get hit if rupee appreciates too much. We should not get hit if commodity prices go up a lot. We should not get hit if commodity prices drop a lot. We make sure that um, there are different sector segments so that any big, which is also the reason why we run a very, very granular portfolio, that we kind of normalize liquidity and macro risk as much as we can.
Sure, thank you for that. Question is, which sector in the equity market are most resilient to global slowdown and valuation correction risk?
Uh, I think utilities. See, typically the defensive sectors are three usually, with like FMCG, utilities, and healthcare. Uh, we like healthcare also, but FMCG, I think the valuations are very high and long-term growth potential is also low. Healthcare valuations are high, long-term growth potential is better. But just if you want to be defensive, I think right now uh, the power utilities are a good space to hide because there is regulated return. Um, Electricity is a good narrative theme globally because with AI and all, electricity growth globally, India actually electricity growth has been not so great last 1 to 2 years, but there is optimism that with a lot of data center investments now picking up in India and hopefully manufacturing picking up, we will see 5-6% growth again. So yeah, I would say that if you just want to be defensive, power utilities are a good space.
How to select good small cap companies that would not be under the purview of today's webinar. We will see, we will try and keep one for that purpose. But yes, as a wealth management house, we are very positive on Bandhan Small Cap Fund. So in the meantime, probably you could look at that as an investment option. Speak to your relationship manager for that. And the final question, which I kept for the last, is sort of like looking into crystal ball and see what do you see in the next 5 years for Nifty.
Simple point is if we are, as I said, the real return on 10-20 year basis suggests we are at fair value, then it is generally proven that if you are at fair value in a long term time frame like 5 years, equity returns will be very, very similar to nominal GDP growth. Now, nominal GDP growth we think will be 10-11%. So we think the Nifty 50 or Nifty 100 will probably do 10-11%.
Sure. Thank you so much for joining us today. And thank you to all our clients, investors who joined in for this call. I'm sure it was insightful for all of you. Wish you a great evening. Thank you, everyone.
Thanks everyone for your time.